My name is Anuj Gupta. I'm from Tag Investments, a wealth management, insurance, taxation, and advisory services firm. Well, the recent volatility in the markets have made us ask common question, which is it bottom? The answer is no, but nobody knows what's the bottom. Well, this presentation is for information purposes only and does not represent any financial or any other advice. Mutual funds and stocks are subject to market risk. Well, we've seen in the past 1 month that whether it is the USA, UK, Germany, France, Japan, and even India markets being tanked by almost 20 to 40%. We've seen crude oil almost tanked down by 40 odd percent and it's at its all time low at $30 per barrel. We've seen the market caps tremendously going down. Almost we've seen a hit of say $7 trillion being hit as far as the market cap of the entire world is concerned. India has taken a hit of almost 40 lakh crores in terms of INR. We've seen crude oil prices being crashed to 30 or dollars as of now, which is a plus for India because we import almost 80% of oil to India. This is the first time when markets are crashing. We've seen gold and silver, which are considered safe havens, also dropping by 11% and 26% respectively, which means that people are just fearful and they are just accumulating cash and they are not reinvesting the surplus from the markets to gold and silver, which in the past we've seen. This makes us believe that risk never takes a holiday, even though it may appear excessively sleepy for long stretches. This is the Sensex Nifty history in terms of the returns which we've seen in the last few years since inception. So if you just look at the chart carefully, we've seen that say in the last major crisis 2008, we saw a dip of almost 52%, but after 2008, the next jump was almost of 76%. In 2010, it jumped by 18%. 2011, it fell by 25%. It was preceded by a jump of 28%. So we've seen positive instances of 72% and negative instances 28%. What you need to closely monitor is before 2008, we saw a good rally of in 2005 of 36%, in 2006 of 40%, and in 2007 of 55%. And then came this downturn or the recession in 2008. Whereas what's different in the 2020 crisis is in 2016, 17, 18, 19, we've not seen a very major jump as we saw in 2005, 6, 7. And 2020 is more of a fearful correction rather than a market cap correction. However, because of the fear, we've seen a market cap going down by almost 40 odd lakh crores in terms of the market cap. So we see a strong bounce back happening in the subsequent years. This is the asset allocation quilt, which we call it. We've tried to put it in the last 10 years in terms of who were the market leaders in the last 10 years. In 2020, interestingly, we don't see any leaders. We've seen gold dipping, we've seen international funds dipping, we've seen large cap, government sector funds, mid cap, small caps, all dipping, real estate all time low. So it's going to be an interesting year. However, 2010 to 2019 makes us believe that whenever a particular asset class has a bad year, it is preceded by a good year. So 2020 is particularly bad for all asset classes. So we see 2021, 2022 being a bumper year or years for the economy. Interesting slide again. So here we've seen the Sensex going from an all-time high from 42,000 to 31,500, a market cap of 160 lakh crores now to 120 lakh crores. So for a very famous parameter to gauge as to whether the markets are overvalued or undervalued is by seeing the GDP by and the market cap. So the market cap to GDP ratio in 2008 when the recession happened was almost 148%, and when the correction happened, it got down to 55%, and then we saw those abnormal returns coming up in the next financial year. Similarly, in Jan 2020, when the markets were all time high, we saw the market cap to GDP at 80%, which is like a fair value. However, because of the recent volatility, the market cap to GDP has dipped to 60%, which is a very, very, you can say, cheaply valued economy to invest in. RSI, this is called the Relative Strength Index, which shows whether the markets are overbought or oversold. So if you see this line, this line shows whether, if anything above this means the markets are overbought, and anything below this line, we see the markets are oversold. So in the recent graph, you can see this part where it is clearly showing that the markets in the last 10 years, it is the first time that the markets are oversold. So whenever markets are oversold, we see a rally in the next 1, 2, 3 years. Again, another interesting slide in terms of the Sensex fall and recovery in the last 20 years. So we've seen since 2004, whenever markets have dipped, they have actually rallied the next year. So in Feb 2000, we saw a peak, and then we saw a fall, and then we see a recovery in 2004. Similarly, in 2004, the markets picked up, then it fell down in 2004, and we saw a rally very quickly coming back in November 2004, so on and so forth. In 2008, again, we saw a market peak out at 20,000, then falling to 8,000. And then in 2009 and 2010, within 1.5 years, we saw a recovery back to 20,000 level. So each time the recovery happened, it actually got a new high. From 5,900, got to 6,100, then a new high of 12,000, then a new high of 20,000, then a 21,000, then a new high of 29,000. And then recently we saw a new high of almost 42,000 in Jan 2020, which has now fallen to 32,000. And as we speak, we are at 30,000. So the next recovery, whenever it happens, whether it's 6 months, whether it's 12 months, 18 months, 24 months, we see it happening and crossing 42,000 level. So we are at a very, very sweet spot for as far as new investments to come up, and which makes us believe that all those who have already put in their hard-earned money into the markets through the mutual fund route, stock route, SIP route, they need to wait for a year, 2 years for the entire money to be recovered and to get a surplus return in double digits, for which we actually invested into the markets. This graph shows that in the last 10 years, the Sensex returns has actually not beaten inflation. So again, it's a surprise to us, but at the same time, the history makes us believe that whenever the 10-year Sensex return has not beaten inflation, the subsequent years, the coming up years have actually outperformed the inflation, and they have given you real returns. This talking We are talking about the total market size here. So the market cap, as far as the listed stocks are concerned, we are at 122 lakh crores. The bank FD is at 120 lakh crores, a healthy 120 lakh crores. The post office schemes are at 40 lakh crores. The mutual funds are at 28 lakh crores. So while while we see the economy not doing well, we see a erosion of 40 lakh crores, but it's not a point of worry because we have actually the majority of the money in bank FDs and post offices. We are talking about, by and large, about the retail and the corporate investors. The total market cap of India is 120 lakh crores of the listed economy. However, in the bank FDs, which is a safe haven, we have additional 120 lakh crores. In post office, we have 40 lakh crores. And to put it into perspective, we are just 8 crore odd portfolios, folio numbers which we have, but unique folio numbers or unique PAN card numbers would be only 2 crores out of a 130 crore odd population in India. So in no way are we into a recession. In no way are we into a crisis mode as far as the entire wealth of India is concerned. However, it is a point of worry, but this is more of a temporary volatility because of mainly because of the virus which we are hearing these days. But we are made to believe that these kind of viruses, although this is a new kind of a virus which we have heard, coronavirus, but we are made to believe that within a period of 6 to 12 months, we do find a way out. and the humans actually overpower the viruses which exist. Just to put it in perspective again, out of the 28 lakh crores, we almost have more than half the money in liquid and debt funds, so which are again not subject to market volatility. So very little money is there kept in equity and hybrid schemes of the investors, for which they need not worry, because major portion of India's wealth is still into fixed income. So our wealth has not yet eroded in terms of the recent market downfall. So a big question to ask is, what should I do in such a time? Whether to do a SIP, whether to do a STP, or put a lump sum. So we have few options for you. First option is probably put, if you have a lump sum money, put it in liquid funds and then do a weekly STP of 83,000 for the next 4, 5, 6 weeks and see how your money grows. Second option is just do a SIP or daily SIP of maybe 1 lakh each till 31st March. Option 3 is, if you have 10 lakh rupees, put 5 lakhs today and 5 lakhs maybe after a week. It's time to diversify. So we see the first recovery coming in large caps and then mid caps and multi caps. A balance fund is always a no brainer. International funds, because we see US economy being revived earlier. So if somebody wants to go for international funds, we would suggest US based international funds. At the same time, there are very interesting fixed income opportunities through the insurance sectors which they are promoting, which are giving you anything between 5, 5.5, 6, 6.5% fixed returns, tax-free returns. So one can also look at diversifying into such asset classes. Uh, for any other customized portfolio recommendations, please feel free to get in touch with us. Thank you so much for patient listening, and wish you a safe and happy environment around you. Thank you.